David Hay joins us today. He is a Co-CIO of Evergreen Gavekal, a fund with AUM of close to $4 billion, and we'll be discussing exactly what he feels is next in our economy. Banking sector, big crisis going on right now, David. This is a very timely discussion, and I'm going to link it to your, well, I want to say new book. It was electronically released last year, Bubble 3.0, and a lot of the themes there are evergreen. No pun intended, but it also ties in very well with what's happening in our current banking environment. So thank you for being on my show today. Looking forward to speaking with you.
Well, thank you, David, and it's a pleasure to be back with you after our last chat. And congratulations on going independent and for the momentum that you've already built up. That's impressive.
Thank you very much. David, let's start by talking about your thoughts on the banking crisis. A lot of different directions we can take here, but just high-level overview, what are the major lasting impacts, irreparable impacts of this banking crisis that we'll see on our society, our economy, our financial system?
Well, there's been so much written and talked about on the banking crisis that it always feel like you're just going over too familiar terrain. But I think that what's a little bit different that I didn't see at all early on, other than some of the stuff I was putting out, is the V word. And by the V word, I mean velocity, because I think what's happening, this great sucking sound you hear, are trillions of dollars that are moving from the traditional banking system and banking deposits into basically government securities. And it's been one of the most bizarre things I've ever seen in my 44-year career. It's something I've been writing about for the last at least 6 months, if not longer, that the amount of money that was sitting uninsured in the banking system, and that number is somewhere around, at least it was somewhere around 9 trillion, and earning almost nothing. So people were taking some degree of risk, and that degree of risk became crystallized, of course, when SVB and Signature Bank failed, and yet they were getting no return, as opposed to going into a government guaranteed money fund with the same kind of liquidity and no credit risk, and a yield in the 4 to 4.5% range. It was just phenomenal, the inertia that was at play for so long that not just retail investors, you might say, well, they don't really know, or they're below the 250,000. We're talking about all those, those big outfits, those startups that in some cases had $100 billion of uninsured money at Signature Bank. I'm sorry, at SVB, and Signature Bank, kind of the same story, but just it made no sense. It was very illogical, but that's changing. People are waking up. There wasn't so much the yield differential, amazingly, that was the motivator. It was once the headlines hit about people potentially losing their deposits or having their deposits frozen that is catalyzing this massive transfer, again, of trillions of dollars into a out of the uninsured banking system into higher yields. But the implication for velocity is that when money is in the banking system, as in the form of deposits, as you know, banks can lend and relend and relend. That's the fractional banking system where it's about a 9 or 10 to 1 multiplier. Once it goes into government securities, that money that's often called high-powered money essentially becomes inert. So if you think about this from just a little quick algebra, this is actually a formula created by Irving Fisher back in the 20s, I believe, that money supply times velocity equals P times T, which is basically nominal GDP. I mean, for all intents and purposes. So money supply times velocity equals economic activity. And so now we have money supply falling. And in real terms, it's falling at the fastest rate since the 1930s. And now velocity, which had been improving, had been turning up after many, many years of declining, is now almost certain to head down. And I think it's going to head down precipitously. So again, combination of falling money supply with falling velocity, I think has very dire implications for an economy that was already looking recessionary.
Just one note on that. I've seen charts of people doing analysis on this. The stimulus efforts for bailing out the banks is equivalent to reversing quantitative tightening. I mean, it's equivalent to more money injected into the financial system, is it not?
It is, though I think what's very different versus QE, during the QE 1, 2, 3, and unofficially QE 4, is that was basically free money that the Fed just created out of its magical money machine and then effectively injected it into the financial system. Whereas these, let's say the discount window, when the banks are going to the discount window and borrowing, gosh, I know it's just been shooting up, so I'm not sure what the latest number is, but I think it's north of 150 billion from the discount window. But they got to pay a high interest rate for that. So it's yes, it does help to offset the liquidity drain, but it's not cheap money. So I think that's the distinction versus a traditional QE type of response. I think what's maybe a little bit more QE like is this system, or maybe it's a yield curve control type of move, where the banks, as you know, can put up their underwater government bond portfolio to the Fed and they get access. Again, it's at a cost, but they don't have to take the losses. So the Fed is lending to the banking system as if those bonds were still trading at par. And that has a 1-year term, which a lot of people, including me, think will get extended. So in a way, why is that yield curve control? It's kind of a stealth version of that because it's incentivizing the banks to, first of all, hold their treasuries, not dump them, and also potentially buy more if they have the ability. But I think what's really going to happen is that the purchase of treasuries is going to be done by companies, private companies, and individuals as they flee the banking system. As I said earlier, those trillions that are in flux right now going into government securities. And I think they're going to go into largely short-term government securities. So what you're seeing as a result of all this is pretty fascinating. You're seeing a pretty rapid steepening of the yield curve. We had a very deep inversion. It's still inverted, but that inversion has lessened quite a bit. And if you look at the history of past recessions, when you really start to get a blaring sound of, red alert, we're going to get a recession, is not when the yield curve is inverted. That's a precondition, of course, but when it starts to steepen or uninvert. And now that's what we're seeing. And as you see this flood of money into shorter term government securities, I think it's going to accentuate this process of returning to a normally sloped yield curve. So it's something that needs to happen. That'll be good for the banks in the long run because, that's another thing that I think got really missed about the inverted yield curve. Inverted yield curve is brutal for the banking system. They live on borrowing short, lending long. So when short rates go above long rates, which is the inverted yield curve, it crushes the bank business models.
Before we talk about what's next, David, I want to talk about the past and what's led to this crisis. Now, your book has discussed our current environment, our current era as being bubble 3.0. And I like to just tie in that theme to what's going on today. I'm going to quote one paragraph from one of your earlier chapters. You said that quantitative easing, QE, was just the first loss of the Fed's monetary virginity. Modern monetary theory, or MMT, has taken its fall from respectability to an entirely new and far more dangerous level. Basically, MMT is much more potent than QE, and in my opinion, much more inflationary. So, describe how MMT has led to what we see today in terms of inflation and in terms of, I guess, some would argue, excess liquidity in our financial system that has partly contributed to this crisis today.
Sure. It's a good point, and thank you for quoting that paragraph. And I guess I should just tell people, because this happens fairly frequently, that you can't buy the book on Amazon, unfortunately. But if anybody really wants a copy of the book, we can get it the digital, they can get the audio. But if somebody wants a hard copy, they should just email us through our Substack website, and we'll get them a copy. So with that out of the way, yes, you're exactly right. So I really started writing about MMT in the spring of 2019. That's when it was first being kind of bandied about as a fringe economic theory, primarily by Stephanie Kelton, as you may recall. And my belief was we were going to ultimately do it in the next crisis. Now, I had no idea that next crisis was really just a year away. In the spring of 2020 is when the government, without any congressional legislation, just kind of stumbled into doing MMT. And so really the difference between MMT and QE, and you may recall there were a lot of people that thought after the financial crisis of 2008, 2009, that the QE 1, 2, 3, that they all sounded like ocean liners, that was going to create a lot of inflation. But this gets back to the V word. The reason it didn't is that velocity collapsed. And that's a point that I was making at the time in my newsletter back in 2009, 2010, 2011. Don't worry about inflation, not with velocity, falling like tech stock did last year. So it's a critical variable. But what happened in the COVID era was that the government really went full on MMT, which meant that not only was the Fed printing up trillions of dollars from their magical money machine, but the government was spending it. They were sending it out to people. So that money became very much injected into the pockets of ordinary citizens and businesses, of course, with the PPP. And guess what? They spent it. And guess what? Also, you had a reduction in the availability of goods. So you had way more money chasing the available supply of goods. And you had some other very structural inflationary forces, which frankly are still in place, such as deglobalization. Everybody's talked about that, but the just in case inventories instead of just in time inventories is an example. And one of my pet beliefs is that this move towards what I call the great green energy transition is quite inflationary. I dubbed it greenflation, and that's not going away. That's going to continue to for the foreseeable future, I think, for years to come. So it was really different once you had the combination of both fiscal, so the government spending and sending the money directly to people and businesses, and the Fed printing in multi-trillion-dollar quantities. That was a very powerful combination. I think you just had to be, I don't know, just not really honest or attuned to the difference, because as you know, a lot of bright people were saying, no, we agree with Jay Powell. This inflation is transitory. It's not going to linger. And for 40 years, basically, I was a disinflationist. I was a bond market bull for most of that 40-year period. But boy, I really had a change of heart when I saw the reaction to COVID. And for a while, it made sense. But as they so often do with these rescue programs, they overstayed their welcome and greatly overdid it.
One of the theories coming out of MMT was that it's not supposed to money printing or money creation is not supposed to lead to inflationary consequences. One could argue that inflation was not caused by money printing. It was caused by supply chain issues. I think the proponents of MMT would probably argue that money creation was not the sole cause of inflation and would point the root causes of inflation to other things, like I mentioned. What's your take?
Well, it's an excellent point. And I think the correct answer was both. It was a supply shortage and it was excess demand caused by that money printing. Because let's think about it this way. In a situation where the money supply was held more or less constant or only growing with GDP, and you had goods shortages, what that typically does is it cuts down on the purchases of those particular goods that are rising rapidly in price. It's because there's only so much money to go around, so something's got to give. So let's say that it's gasoline at the pump that goes way up. Okay, well, consumers kind of have to have that. That's a pretty inelastic demand situation. But then they're going to take that same spending from some other area. So maybe they don't buy a car. So normally, if the money supply is held pretty much in check, you get that kind of substitution effect. So the essentials get by, and that's kind of a normal recessionary kind of situation. That's why the more big ticket items tend to get clobbered in a recession, and the more necessities of life continue to see ongoing demand. But when you create almost unlimited liquidity and then get it in people's pockets at the same time that you have a supply shock, it's just a disaster. And we're still, even today with a lot of commodity prices that have come down significantly, energy prices have cooled drastically. And yet we still have this kind of stubborn inflation rate of, 4, 5, 6%, depending on which way you want to look at it. Now, I do believe, David, since I'm in the recession camp, and I joined that reluctantly in June of last year. Before that, I thought we might have an inflationary boom, but once the yield curve deeply inverted, that really changed my mind. The money supply falling, leading economic indicators have been down for 11 straight months. You put all those things together, and I think to deny in a recession is a pretty low probability belief. And then you throw in the banking crisis that came out of the blue. So it's, that's going to pull down inflation for a while. But I do think that we'll see kind of a 1970s type of thing where inflation, maybe we get it down to 3 or 4% and then it takes off again. That would be my most likely prediction regarding inflation.
You wrote about 2008 in your book, Bubble 3.0. Let's talk about the transition from Bubble 1.0, and perhaps you can explain and define these terms for the audience. 1.0 to 2.0 and now 3.0. You wrote, this is a critical reason, you were talking about the banking crisis, why Bubble 2.0 turned out to be much more lethal than Bubble 1.0, namely it involved the banking system. I don't know if you meant this to be rather prescient, but it turned out to be. Now, let's talk about what these terms mean, bubbles 1.0, 2.0, and now 3.0, how they differ from one another. And I believe last time we spoke, you were talking about how we're currently in the largest bubble of all of human history, correct?
Absolutely. Okay, great setup. Thank you. So bubble 1.0 was the tech bubble, which hit its crescendo in early 2000. And as you're aware, and I think most of our listeners are, the NASDAQ fell in the wake of that by almost 80%. It was a 1930s type of decline. So that, but it didn't really involve the banks. So it wasn't really, I mean, the recession that followed that was actually quite mild, even with 9/11 happening, 2001, obviously. So, but then the Fed felt a lot of pressure to do something. It cut interest rates, of course, frantically, and it had a lot of room to cut because I think they got the Fed funds rate north of 6% in 2000. But it wasn't enough. The economy was still pretty soft, but not bad. However, some very high-profile people like Paul Krugman were beating on the Fed that they needed to create another bubble to offset the implosion of bubble 1.0, and the Fed eventually complied, and they left interest rates at basically 1%, even as the economy took off in 2003 and 2004. And in 2004, the Fed realized they were starting to get an inflation problem, so they started raising interest rates, but it was too late. Bubble 2.0 was well underway, which of course was the housing and mortgage lending bubble that was the basis of the Big Short and almost crashed the global financial system. So to what you were asking or pointing out, once you threaten the banking system, once the banking system, it's built on confidence and trust. And when that confidence and trust is lost, and you see these big banks like Washington Mutual fail, or you had AIG, which is a big insurance company that almost went down. And of course, the first one was Bear Stearns, followed by Lehman. I mean, the domino effect was terrifying. And the government was very slow to respond. They were very slow to recognize how serious that was. So that was bubble 2.0. And the bursting of that bubble then led us to bubble 3.0, which, as you alluded to a moment ago, I believe, and I think there's a lot of hard evidence that it was the biggest bubble of all time in recorded human history. And the reason for that, the primary reason for that, and we're now seeing the wages of this, I mean, it's very much behind this banking calamity, as you correctly referred to it, because we drove interest rates, or the central banks in the Western world drove interest rates, and in Japan, to either basically zero or to negative numbers. There was something like, at the peak, 17, 18, 19 trillion dollars of global bonds around the world that had negative yields, something we just never thought could happen. There were homeowners in Denmark that were getting paid to take out a home loan. You can imagine one of the most, Alice in Wonderland types of developments in a world that was full of bizarre things. So when you push interest rates down to low levels, I mean, not even low, but either nanoscopic or below zero, it's going to create all kinds of distortions in asset prices. And because it persisted for so long, then the banking system is in this position where, how do we make money? And then after COVID, and this is another interesting twist, is that because of all that money that was created, the banks got flooded with deposits, right? So Silicon Valley Bank's deposits, triple almost overnight. They get all that money. What do they do with it? And at that point, the interest rates were still negligible, but there were some, I mean, at least in the US. So they would go out and they would buy a longer term treasury yielding 1.5%. They were paying almost nothing for the money. So they were making money. It seemed kind of easy. But then, of course, Powell and the Fed, I mean, has to take blame along with a number of the other Western central banks and basically assuring the banking system that they would keep interest rates at low levels because, again, inflation was transitory. And that inflation is transitory, alibi had some really serious negative repercussions. So then the Fed starts to raise, and as we all should be cognizant of, this has been a Volcker-like increase in interest rates, very rapid, very significant. So all of a sudden, the bank's funding costs go through the roof, and now they're sitting on these losses in their portfolio. Now, this is a nuance that is kind of tricky, but banks have two different categories: hold to maturity, available for sale. Now, apparently, and I don't know this for sure, but I got this from a very good source, the hold to maturity bonds, they couldn't hedge those. They couldn't they couldn't buy puts or use futures or anything. They couldn't do any hedging on their hold to maturity portfolio. But they could do that on the available for sale. But the available for sale is where you kind of have to mark to market. Hold to maturity, so, well, we don't have to take these losses. We can just sit on them. But if you start losing deposits in such large quantities, which is what happened with Silicon Valley Bank, that money was moving out in Twitter time. So then they have to sell their hold to maturity government bonds that are now underwater and take big losses, which then threaten the capital base of the bank. So it was a very nasty chain reaction. But if you get back to what was the ultimate cause, it was these ridiculously low or even negative interest rates and keeping them there way, way too long.
A common theme I'm hearing amongst these bubbles is monetary policy, as you just alluded to. One could argue, though, that the last bubble 2.0, around the 2008 financial crisis, partly popped because of poor banking standards, which were supposed to be fixed following the financial crisis. We saw banks lend to people that shouldn't be qualified for loans, ninja loans. Mortgage-backed securities were packaged in such a way that really exacerbated risk to an unbearable extent. And so one could argue that it was really corporate greed that caused the collapse of the bubble. It wasn't really a factor of monetary policy. Independent of what the Fed was doing, the banks would have failed anyway. Do you agree?
Well, I think what you referred to was that time different. Were they taking really unconscionable risks back then, lending this, letting strippers have 8 different rental homes, down in Florida? Yeah, but I think it was just a different kind of greed or different kind of blind spots. The belief back then, and even Alan Greenspan articulated this, is that the banks really weren't taking a lot of risk because they were packaging those dodgy loans into, CDOs, collateralized debt obligation packages, and then they would put them into tranches. So there'd be a AAA rated tranche that was heavily insulated from the losses, and then there was the mezzanine, and then the equity tranche, which had the highest yield, but took the first losses. And they were selling those into basically the shadow banking system. And yet, what everybody seemed to miss is that, let's say Washington Mutual was busy packaging and selling, but their investment department had all this money, so they had to put it someplace. They were buying that stuff. So it was really just kind of doing a big circle and coming back on, even if it wasn't their own originations. So what was viewed as being a positive, this offloading of risk, actually turned out to be a negative. And the reason it was so negative is that if you were retaining, like a traditional bank, if you retain these mortgages on your balance sheet, you'd exercise a lot more care. But because they thought they could get out from under it, that's, I think, was probably one of the biggest misconceptions and errors of commission that happened back then. Now, this one is different so far. I mean, really, even Silicon Valley Bank supposedly has a solid loan book. I mean, I'm a little skeptical given what I hear about how aggressive they were in financing VC type companies. But certainly what brought them down was the fact that it wasn't their low quality stuff, it was their high quality stuff. As somebody once said or wrote here recently, that might have been the subprime crisis back in 2008, 2009. This was the prime crisis. So it's a very different, but I think it's greed too, because the banks, they were loving the fact that they could access all that money for virtually nothing. And those trillions were just sitting there, I think very foolishly. So that was a different form of greed. And then, trying to, play the yield curve. And when the yield curve flipped on them, it was just game over for the weak ones.
It does seem to me, and please correct me if I'm wrong, but it does seem that 2008 was more of a systemic issue that originated from the collapse of the housing market all the way down to the banking sector, which, of course, held onto these housing products, whereas this time seems to be micro mistakes on a company level. For example, SVB, Silicon Valley Bank, one expert, I'm just reading an article here from a couple weeks ago, one expert concluded that, and I'll just quote, SVB collapsed because of a stupid rookie mistake with their interest rate risk management. They invested short-term deposits into long-term bonds. When interest rates rose, the value of the bonds fell, wiping out the equity of the bank. It seems like a case of risk mismanagement rather than a systematic failure of an underlying asset that's going to wipe out all banks. Do you agree?
I do agree. I think this is going to be a situation where the strongest banks come out even stronger. And that's not all great, because I think you're going to see even more concentration into the big banks, the systemically important banks. And so it's going to be very Darwinian. But yes, I think that's right. Whereas back in 2008, 2009, I mean, it was basically every major institution in America, if you really mark to market, was broke because their AAA rated debt, those AAA rated tranches of the CDOs were trading at 30, 40, most 50 cents on the dollar. And that was the safe stuff. So even a JP Morgan back then was basically broke. However, according to Chris Whalen, and I don't know if you ever listened to Chris, but he's one of the brightest minds in the banking industry. He's been warning for months that this belief that higher interest rates were good for the banks had a dark side. And he's been very right. And he did say that as of the end of this is again him, I can't verify, but it kind of makes sense that if you really mark to market all of JP Morgan's assets again, not just their government bond portfolio, but also their loan book, they would have had a negative equity as of the end of 2021, JP Morgan. Now, again, a lot of this is because bonds are down and they can sit on those bonds and they have a much stronger capital structure and their deposits are stickier. And so I think you're right, but I just want to point out that this is no, walk in the park either. This is a serious banking crisis.
Well, could you say that an underlying theme then that affects all financial institutions, big or small, would be the unprecedented rate at which interest rates are rising?
Absolutely. And to be fair to them, again, they were encouraged to do certain things by the forward guidance, that lovely term, or in this case, forward misguidance.
Was this not the most telepathed series of rate hikes ever? Or not?
Well, once it started, sure, but before that, I mean, it was like flipping a switch. I mean, the Fed went from denial about inflation and all these pacifying words about, you don't have to worry, we're going to keep interest rates down, indefinitely. And then all of a sudden, it was kind of the spring of last year that the Fed hit the panic button. And this is something that I was writing about, back in 2021 and into 2022, is that they were so complacent about inflation, they got so far behind the curve that to catch up, it was a classic. Instead of tapping the brakes, they had to slam the brakes on and throw out the parachute behind the drag racer too. And when that happens, somebody's going to hit the windshield, and a lot of somebody's are hitting the windshield right now. So I think as usual, I mean, that was kind of the main theme of my book, is that the Fed has been this recurring perpetrator of this increasing financial market instability. And Jim Grant has this great quote that I think really, it's pitch perfect, is that the Fed is both the arsonist and the fire brigade. They create the fire, but then they put it out, and they're a good fire brigade. I mean, they have really developed some great tools to fight, this kind of the systemic panic that happens. But the trouble is they tend to stay in fire brigade mode too long. So what they basically do is sow the seeds for the next bubble. And, we certainly saw that. But I mean, QE1 was supposed to be temporary. And yet we got 2, 3, and then, I call it QE4. People say, well, they didn't really announce that. But in September 2019, when the repo market blew up, they started QE4. So they were printing almost $100 billion a month, even before COVID hit. So I think the Fed deserves an enormous amount of blame. Jeff Gundlach says you should just get rid of the Fed and just use the 2-year Treasury as your rate setter. And, I think there's a lot of truth to that on a day-to-day basis. Now, when you have a crisis, it's nice to have somebody like the Fed that can, stop this chain reaction or this domino effect of bank failures. Because we saw that in the 1930s. We saw how horrible that can be. So they do have a role, but they just overplay their hand time and time again. And it's, then it's tougher. Every time it's tougher. You got to do more of a bailout.
I'm going to give you one case for inflation and one case for deflation, or at least disinflation. Now, the disinflationary case is rather straightforward, which is that as the banking sector faces difficulties, we're going to see a tightening in credit, which is going to lower aggregate demand. The inflationary argument would be that interest rates at elevated levels would actually put pressure on corporate entities to raise prices to combat higher interest expenses, especially if they have to refinance later this year or next year at higher rates. That's actually significant if you look at the corporate debt level, which is at the highest in history in nominal terms. Which camp would you be in?
I'm in both. So it's just a matter of timing. I think we're definitely in a disinflationary cycle right now. And because of this recession, I think you're going to see, I think it's going to be very difficult for companies to pass through increased prices. You could do that during the post-COVID period when you had all that excess liquidity. But again, falling money supply, falling velocity, I just can't emphasize enough how critical those are. I mean, it really is, an accounting identity. And so when you get that happening, what does that mean to nominal GDP? It's going to be contracting. And now I know that seems like a stretch right now when you've got nominal GDP still running pretty strong because there's this inflation that's in the system right now. But if that inflation rate does come down at the same time you've got negative real growth, then at least you could get to a very low nominal GDP number for a while. But again, I think this is temporary. And I also think that, so this is a good lead into my at least two mega risks. I've kind of got a third one now, but my first mega risk is a implosion of the global housing bubble. And we're starting to see that. And the bubble this time was actually much bigger than it was in '07. And it's like it was back then, it's global. But in countries like Denmark that we talked about, or Sweden, where home housing prices are already down almost 15%, Canada, New Zealand, Australia, some of the other Nordic countries besides Denmark, maybe a little stretch to call that Nordic, but it's close. Anyway, the prices were far higher than where they were in 2007. And also there's a lot more mortgage debt out there. So these debt levels in these countries are way higher than the United States. And our bubble was bigger than it was in '07 too. So that appears to be bursting. That's one of my mega risks. The other one that's more relevant to what you brought up is the potential for a U.S. fiscal funding crisis. So what if we get into a recession where long-term interest rates actually go up? I mean, short rates could come down. That's how you get back to a steep yield curve, right? If long rates stay the same or go up and short rates collapse. And I think that's what we could be looking at. But why do I think we could have a U.S. fiscal funding crisis? Because if you start running the numbers, we're looking at trillions of dollars that needs to be raised for the government versus, say, a year ago. So if you just look at QE versus QT, so the Fed only stopped QE about a year ago. Prior to that, it was buying $1 trillion roughly of government debt every year. Now it is selling $1 trillion a year of government debt. That's a $2 trillion delta right there. Then you've got U.S. tax receipts going down because a lot of the tax receipts were driven by frothy asset markets, both real estate and stocks. And you're gonna have higher support payments going out as we're starting to see. I saw your most recent interview with your guest. He was pointing out, I don't really believe these labor numbers. I think that this jobs market's much softer than the official, Department of Labor statistics. And he's, he said, it's almost every day you pick up the paper and there's another 10,000 people being laid off. So if you start getting this into this true recessionary situation, the federal government's going to be spending a lot of money sending it to households to get them through. So that's going to be trillions of dollars of delta as well. Less revenues, more spending. So who's going to buy all that treasury debt? And I actually had a very bright guy on my show here a few months ago, and he said, oh, don't worry, the banks will buy it. Well, I think that's not going to happen anymore. I don't think the banks will buy it. Now, I do think that you're going to get the tsunami of money moving out of the bank deposits into treasuries. But again, I think it's a very short end. So I think you're going to have a glut of money going into short-term treasuries and a deficit of money going into longer-term treasuries. So I mean, if the government's got to pay, say, 5%, maybe 6% to finance long-term treasury bonds because the supply is overwhelming, that's going to be a very tough situation for the government to be in. And I think it's almost untenable. As a result, I do believe before too long, the Fed's going to have to go from QT back into QE. So from quantitative tightening, once again, to quantitative easing, in other words, restarting their magical money machine. And it could happen at a time when inflation is still uncomfortably high. The other thing I think could happen in a recession that would aggravate the situation is another spike by oil prices. I think oil prices at 70 are crazy low. And I think those prices are going to go up significantly through the course of the year. Those two things don't happen typically in a recession, rising long-term interest rates on treasuries and rising oil prices. I could be completely wrong, of course, but I think they're non-trivial risks.
All right, let's put all this together then and how you think Bubble 3.0 will likely unfold, the most likely of the risks that will take place, and how financial markets, capital markets will be impacted as a result. I'm curious to see how you think the stock market in particular will react to QE during a recession.
The stock market will like QE once it happens, but just to be clear, I don't think that's going to happen right away. I think the Fed is going to continue to play tough here for a few more months. And I think the banking problem is, that is a game changer. That's probably going to accelerate when they go to, restart the magical money machine. But I still think they're going to play tough here for a while longer. But so In the meantime, who knows how bad it's going to get? What I think is clearly happening right now. I mean, I do believe you can still argue about whether we're actually going to get an economic recession, but our earnings recession is upon us. Last quarter was down. This quarter is almost for sure going to be down. So, and David Rosenberg thinks it's actually been going on for 4 quarters. I'm not sure about that. Maybe if you back out energy, because as I think you're aware, last year, energy was the main prop for the S&P 500 earnings, despite being a small percentage of the index. So the earnings recession happens, and the layoffs occur as companies because they can't raise prices for the most part, so they got to lay people off, and labor is their number one cost. And people say, well, that can't happen because the jobs number is so low right now, but that's really always the way it is going to recession. So that's not abnormal at all. And if you look at the leading indicators of the jobs market, like people working part-time or temporary help agencies, I mean, those leading indicators are flashing at least bright orange currently. So I do think you're going to get an economic downturn, and that's going to panic the Fed into restarting QEs. But again, I think that's going to be good for risk assets. But I think there's certain risk assets will benefit, and some not so much. So obviously, those that are more hard asset based, energy, really like uranium, copper. I mean, there's definitely some areas, the precious metals. Although gold has all of a sudden went from being hated to very popular very quickly. So I'm a little worried about gold being a little near-term overbought. But I think you want to be in things that the Fed can't print.
I don't mean to be flippant with my next question, but do you like the financial sector as an investment? Given that I'm going to bring up a point you mentioned earlier, which is that the best banks are going to be left standing. So if you are right, first of all, which of these banks will be left standing? And second, don't you think a consolidation of the banking sector will make a stronger investment case?
I think yes, I think that's true. I think that it is, it's a complex question. I mean, on the one hand, I understand that you need to have a vibrant community banking industry. On the other hand, I also realize when you get these thousands of banks out there, it's tough to regulate them. So it's a difficult situation for policymakers, and that's one of the few areas I have empathy for them in. But I do think in general that we are moving, as I said earlier, into this Darwinian environment, and therefore those that are the strongest could actually come out of this doing very well for investors. Personally, I'm a big fan of Charles Schwab. It's come down hard. I will admit Jim Cramer was pounding the table on it yesterday, which does give me a little bit of pause. But I think his thesis in this case is strong and accurate. They've got a diverse business line. I think that's important too, is that you want to have a financial institution that's got multiple lines of operations and multiple revenue sources, and they definitely have that. And they've also got a pretty sticky depositor base. But even what they're admitting, and this gets back to my very first point and overarching one, is they're seeing this velocity retarding behavior on the part of their client base, where they call it cash sorting. I don't know if you've heard that term, where the customers are saying, okay, get me out of your sweep fund, which pays nothing and is uninsured, and put me in your government money fund. And so that's going to hurt their earnings too. I mean, I really do think that's one of the big negatives for all the banks right now, is they're losing that basically zero cost funding, and it's going to be much more expensive. So it's, again, near term, I think all the banks have problems. But I think at the end of this period, you'll have the strongest coming out in really good shape. And I mean, I think JP Morgan's an obvious beneficiary of what's going on. And even Capital One, which I was looking at, their capital ratios are very strong. And so they're definitely going to be winners and losers. And so, I'm not trying to be alarmist. I think the system will survive. I'm not sure the dollar is going to survive as we know it. Just to throw out one, kind of end game thing, I do believe the dollar will have to be backed by real assets at some point.
I can't just not address what you just said. What do you mean the dollar is going to have to be backed by a real asset? It's not going to survive in its current form? Why not?
It will survive. But the cost of survival, I think, will become unaffordable at some point. And that unaffordability is going to manifest itself once again in inflation. And as we know, the Fed can't, or the federal government can't default. It can always print more dollars. But, printing more dollars, let's say, to make the interest payments and entitlement payments. And, Jeff Gundlach says that the actual true amount of debt out there, if you include the off-balance sheet entitlements, is something like $150 trillion. There's no way the government can handle. They can't pay the $30 trillion or so of debt that they've got right now that's official and on balance sheet. So there's only one way out, and that's the printing press. And so you got to recognize that. And if you recognize that as an investor, I think you can protect your purchasing power, in real terms. Whereas I think this is one of the points of my book, and again, we published it digitally before last year played out. Last year was the worst year for a balanced portfolio since 1871.
Mm.
So the idea that you can hide out in bonds was proven to be wrong in the old days. From 1982 to COVID, it was true. Bonds were a great counterbalance, but when you get into an inflationary time, everything changes. And what I'm saying is that I actually believe the inflation that we're facing once we come out of this recession is going to be higher than what we had when we were going through COVID or the COVID recovery. So at some point, the dollar has to be addressed. I mean, it's this fiat currency. It's not backed by anything but the tax revenues. Tax revenues can't cover it. So you can get away with that for a while, but at some point, I think you have to create a sound dollar once again. And I don't think the markets will trust the U.S. government. I mean, one thing that you're seeing, David, we're all seeing is this utter disregard for the rule of law in the West. It happens in the United States. Look at what happened with Switzerland here with this Credit Suisse and merger into UBS and these bonds that were wiped out, and yet the equity survived, at least in reduced form. And there's just a lot of stuff going on that is shaking people's confidence in Western governments, and that's not healthy.
Let's follow up next time and have another 30-minute discussion on what you just said. Lots to unpack there. We're running out of time today. Unfortunately, I can't talk about the dollar in greater detail. I do want to finish on this note, bubble, the definition of a bubble, and what you think, which asset you think is in the greatest or is the greatest bubble right now. I'm just going to quote another fun passage from your book here. You wrote that, what is a bubble anyway? Some may suggest that a bull market is one in which an investor is a participant, while a bubble is one in which he or she isn't invested. Funny quote. There is some truth to that joke. If you had bought Bitcoin and held it, you wouldn't have thought that it was a bubble. Otherwise, you wouldn't have held it. And a lot of people who think that Bitcoin, for example, was a bubble weren't an investor.
No, you're right. I think that's just human nature. That's the way we react to things. And, unfortunately, I think people misuse bubbles. Like, bubbles are great if you react to them in a rational, disciplined way, which is to sell into them methodically. Not all at once, because bubbles have a tendency to go up way more than you think they should. But to continue to add to something that's in the throes of a bubble, that's just financial suicide. And unfortunately, that's what far too many people do. One thing I would say that I didn't touch on earlier, but it does relate to your question, is I think one of the biggest bubbles was commercial real estate, particularly office buildings. And, being from the Seattle area, just the number of cranes that were operating in Seattle and Bellevue. At one time, Bellevue was called Little Beijing. There were so many cranes operating, and that bubble is bursting big time. I think that commercial real estate is going to be an utter disaster, especially office buildings. Office buildings are about 50% vacant. Now, that doesn't mean they're not leased. The leases are still in place, so unleased is about 15%, but vacant's about 50%.
Is that because of the work from home culture that we're seeing now, or is that just because of oversupply, mismanagement of supply?
I would say yes and yes. I think it's a combination of both of those, but also realize that 70% of commercial real estate loans are held by small banks. So to the extent that they're seeing this deposit outflow, and by the way, deposit outflow is running at the fastest rate since 1981. So this is not just Dave's paranoia. This is really happening. So these banks are in a nasty squeeze, and companies are going to be looking to cut costs, and that's a big cost for a lot of companies, in addition to labor. So I think this commercial real estate thing is going to be a disaster. But there are, I can't say that in a blanket way. There are definitely going to be pockets of strength. But office buildings in general, and particularly these overbuilt cities, I think it's just going to be a wipeout.
Reminds me of this article I read the other day. This author suggested that in New York City, they convert all the empty offices to residential apartments to solve the housing crisis and to solve the oversupply issue of commercial real estate. I think they're joking, but it does illustrate your point. So how does that play out then? Are we going to have another housing crash?
Well, the area you kind of go in this direction a little bit, and that's multifamily, because as you say, if you move these office buildings to multifamily, maybe that's going to help address the oversupply of office buildings. But you're already seeing housing. The good news for single family is that you didn't get the overbuilding that you had back in 06 or 05 to say 07. Whereas this time, apartment building construction has just gone through the roof. So that looks to be another area of problems. But one thing people can do to kind of protect themselves is we didn't talk about range expansions. But if you look at the charts of the, say SL Green, which is a big office building holder in New York City, or NATO, I mean, they took out multi-year support and then they've just continued to crash. And if you looked at a chart of Credit Suisse and you looked at what the multi-year support was, I mean, you would have avoided most of the pain. And that's one of the key things I keep trying to tell people. Pay attention to those things both ways. When they break out, that's good. When they break down, that's very bad. So, it's one of the most important things I think I convey to my readers and hopefully to your listeners.
Well, excellent discussion. Thank you, David. You are an excellent author and writer. Unfortunately, your book is not, there's no link to buy your book, but we can read your Substack. Where can we find that?
Yeah, just go to the Haymaker at Substack and you'll find us pretty easily. And we do a free letter on Mondays called Making Hay Monday, which is it's got a lot of specific market guidance type of thing. A lot of it does relate to range expansions. I'm hoping to be able to put in companies making 36-month highs because that's kind of our break point, 3 years, 36 months, highs and lows. And then also we do the Highlight Reel Haymaker on Fridays, which is just kind of a quick summary of what's happened recently.
Right.
And they're both free. Everybody's favorite price, as I like to say.
I'm just on a more personal question. I mean, you're a successful fund manager. You've got a lot to do already. What is your motivation behind writing the Substack to educate people? What's in it for you?
Well, at this point, a lot of losses, a lot of negative cash flow, just like with my book. David, don't ever write a book. It's a very expensive process. But, I've been very blessed. I've been very fortunate. I do like helping people. But, we do get kind of accidental benefits from it. It certainly has driven a lot of new clients to Evergreen over the years, Evergreen Gavekal. So that's been a current benefit. Someday, I hope that we're actually able to monetize the Haymaker, but we'll see. But it will always be very affordable financial guidance under any circumstances.
All right. Well, let's keep tabs on that endeavor, and best of luck with that. I'll love to have you on soon to talk about, financial news, whenever that may be. I'm sure there's going to be plenty to discuss over the next couple of months. So thank you again for coming on the show.
Thank you, David. And again, congratulations on your fast start.
Thank you. And thank you
Talk to you soon.
Yes, thank you. And thank you for watching. Don't forget to subscribe.